Hello, good morning, good afternoon, or good evening, wherever you are in the world today. Welcome back to the Sustainable Investment Forum Europe. My name is Ben Caldecott. I'm your chair today. My day job is running a research centre at the University of Oxford, but it's been a great pleasure to kick off the forum this morning, UK time, and we're now continuing with the afternoon session this afternoon. So we've got a great opening session, which I'll tell you about in a second, but I just wanted to run through a couple of things. Firstly, the organisers, Climate Action, in partnership with UNEP FI, have transitioned the Sustainable Investment Forum to a virtual event. This is the first time that's been done. And what we've been discussing over this first part of the forums is how can pension funds align with Paris? How will COVID impact sustainable finance? And what can investors do to properly integrate ESG? The official event partner is UNEP FI. Over the last 5 years, Climate Action and UNEP FI have been working together. Many of you will know UNEP FI. They have hundreds of financial institutions who are members and partners, and they've been responsible for launching every few years very significant initiatives, including the Principles for Responsible Investment in 2006, the Principles for Sustainable Insurance in 2012, and the Principles for Responsible Banking that came out last year. And just a quick reminder for your diaries that on the 22nd of September, there'll be a special session focused on the Principles for Responsible Banking and how they've developed over the last 12 or so months. It's been one of the most significant developments in sustainable finance that we've seen recently. So put that in your diaries. The Sustainable Investment Forum is the headline partner. The key sponsor is NN Investment Partners. They're the asset manager of NN Group. You can visit them in their virtual booth on the platform online and interact with them and meet with members of that team. We'd also like to thank, or I'd like to thank on behalf of the organisers, all the different sponsors, the exhibitors. There are many, you can see them listed, and again, you can engage with all of these organisations through the online portal and platform. A couple of housekeeping points just to emphasise that this is being recorded, which is a good thing because if you aren't listening now, you'll be seeing this hopefully later on demand. The videos get made available shortly after each session. I've mentioned this virtual expo. You can gain access to the latest industry research, white papers and so on. You can also undertake engagement, networking with peers and with sponsors and with other partners. Do take advantage of that over the breaks and over the coming month. Tell us how we have done. This is the first online version of the Sustainable Investment Forums. It's important to get feedback. Climate Action, I know, will be integrating that into future events. Think about upcoming sessions. There's a lot happening over the next month. Make sure you put things in the diary. I've already mentioned one on the 22nd of September, but there are many other things. And then you've got the opportunity every week to engage with industry leaders. You've seen some of the really heavy hitters who are speaking as part of this. You can interact with them and engage with them through the platform. Other thing to say is that we want to keep this interactive, so please use the online platform to engage in live discussion, ask questions. Just make sure that you tag who you want to ask the question to, and if possible, say who you are and what your organisation is, although of course, if you really want to ask a very provocative question, you can do so anonymously. On Twitter, you can also ask questions. The details are on your screen. Please do engage with social media. Don't be shy. Okay, so the meat of this session, this afternoon session UK time, is on overcoming the ESG data challenge, approaches and methods when dealing with diverse data. And this is going to be super interesting. And actually, I wish I was a panelist because this is something that I spend a lot of time on professionally. But what I wanted to do is hand over to Naomi, who's going to be chairing this wonderful session. And Naomi is the CEO of Asset Resolution, which is a spin out of 2 Degrees Investing Initiative. Many of you will know of 2 Degrees who do stellar work across a number of different aspects of sustainable finance. So over to you.
Thank you, Ben. Good afternoon, good morning, everyone. Ben, I hope we'll have you in the next panel, as you always have insightful remarks on this topic. So we've seen over the past few years a huge increase in ESG data, and this is not surprising given the evolution of the sustainable finance field. So it's great to see these new initiatives appearing, the new providers appearing, and existing providers moving into the ESG space. but it also raises some challenges. So there are challenges around the standardization, the comparability. There are some gaps. The further people want to go, the more data they need. So this afternoon, we have a distinguished panel who will discuss some of these issues and who will also discuss the solutions they have, the suggestions they have to improve and expand ESG data and how they think ESG data will look like in the future. And we have a panel that brings together not only data creators and researchers, providers, so commercial as well as non-commercial, as well as data users and people who develop tools on the back of this data. So on our panel, we have 5 experts today. So we've got Jacob Michelson, who is Head of Finance Advisory at Nordea Bank, who is CFA Credit Portfolio Manager at La Française Asset Management, Mervyn Tang, who is Senior Director and Global Head of ESG Research at Fitch Ratings, Laurent Balbuquian, who is Director Capital Markets at CDP Europe, and finally, Lisa Eichler, who is co-head Climate and ESG Solutions at Ortec Finance. And before asking the panelists to introduce themselves, I'm going to say a few words on asset resolution. Ben already mentioned that we're a spin-off of the 2 Degrees Investing Initiative that some of you might know. And as part of their research, the 2 Degrees Investing Initiative developed a methodology that ties real assets in the real economy, in the most emitting sectors, to companies and financial instruments. And their mandate is research, not commercialization. So they decided to set up an entity, Asset Resolution, to be able to offer this data to the market. So at the moment, we are providing forward-looking climate-relevant data on over 300,000 physical assets across 8 of the most emitting sectors that are then linked with 80,000 companies, some tiny, some large, and financial instruments. So that allows financial institutions to run analysis on their portfolio. So now I will give the floor to Jacob, who will introduce himself and give his opening remarks. Jacob, the floor is yours.
Thank you much, Nomi, and thank you all for taking time to listen to hopefully an interesting discussion here today. I'm very excited to be part of this panel. I think there's plenty of interesting and relevant discussions coming up over the next couple of weeks, but in particular, I've been very excited about this one for quite a while. So thank you so much for letting me share my thoughts here today. And very briefly on that, as Noemi introduced, I am responsible for sustainable finance advisory at Nordea. So that really encompasses the broader discussions around sustainable finance, including ESG data, with our clients on both the investment side and also on the corporate side. And clearly the topic of ESG data is one that is very much on the top of the agenda when we're meeting clients. And I think really to set the scene, it comes not just from an ESG perspective, but really from a data perspective as well, with data really being said to be the oil of our time. And obviously for ESG data, maybe a slightly more greener version of that data, but nonetheless clearly relevant. It's also something that really looks set to develop and transform the market over the next couple of months and years. We've already seen a lot take place in form of market consolidation and increased data points. And lastly, really, it's about a lot of different stakeholders coming together. So it's not just about companies and investors. It's also about analytical companies and advising around ESG data. So it's a really interesting topic.
Thank you, Jacob. So now moving on to Marie Lasseigneur. Marie, the floor is yours.
Hi, everyone. Hi, I'm Marie. I'm a portfolio manager at La Française, and I specifically manage 2 of our credit carbon impact funds across investment grade and the high yield markets. So my perspective is as a user of the data, as I obviously need consistent data across markets and geography to make sure I can link non-financial information to our investment decisions. The way we currently do it, and we integrate ESG and the wider thematic of climate change here, is going beyond specific project or structured bonds, but going looking at the strategy of the company and how their strategy to decarbonize is matched with investments and R&D, etc., and organization. And this is really where my data focus is. Sorry about that. As the exercise we're trying to achieve here is to find which companies are aligned with the 2 degrees world, and find the ones which balance sheet are going to be affected by the transition to a lower carbon world or a more ESG aware world. Thank you.
Thank you, Marie. So now, after the user perspective, we're going to move to Mervyn, who is going to bring the provider's perspective.
Hi, my name is Mervyn Tang. I head ESG research globally at Fitch. And so I would say I'm a data user and a data transformer. In the sense, as a credit rating agency, we need to use ESG data to understand how ESG issues like climate change affects credit ratings. And it can do so in a host of ways. The fact that banks and asset managers are using this data could mean that poor ESG performing companies could have trouble financing. It could mean, in terms of high carbon intensity companies, they might be more exposed to tightening regulation. We need to understand ESG data to be able to make those credit decisions. Now, as a credit rating agency, we're also trying to be more transparent about how ESG issues affects credit ratings. So we transform some of that data, incorporate into other credit decisions, and come out with transformed data to indicate how ESG issues are material to our credit assessment. And so I want to give the provider of someone who both uses the data and also tries to distribute it to investors for certain use cases.
Thank you, Mervyn. And I'll add to my data stakeholder mapping the data transformer category then. Now moving on to Laurent from CDP Europe.
Thank you, Noemi. I wanted to thank Climate Action and UNEP FI for inviting CDP at this event. As you know, CDP is, I don't know if you know, but CDP is the main environmental reporting platform in the world on which we have corporation reporting environmental data every year, but also city, state, and region. So this has enabled CDP to build the world's largest corporate environmental database. So I would say that we are the raw source of data to the market, of environmental data. We don't deal with the S and the G, we only deal with the E. And we give this data to the people who are giving us the authority to do this job, which is what we call the signatory investors, of which the investors who are around the table are a signatory investor of CDP. They receive this data to be able to do their job of selection or deselection, investable universe, and properly their ESG job. So I would say that, and finally, the last point is that we decided a couple of years ago to give a score to corporation, but it's not a credit rating or non-financial rating score. It's a score, I would say that it's a pure score that measure the environmental performance and the environmental impact of a corporation on climate change, water security, and deforestation. These are the 3 thematics that we develop. That's it.
Thank you, Laurent. And last but not least, Lisa, who brings the tool to the data and who will be able to say a few words about that to close the introduction session.
Yes, hello everyone. My name is Lisa and I'm co-heading the Climate and ESG Solutions team at Ortec Finance. And like Noemi already said, we like to say that we bring indeed the tools to the data. What that means is that Ortec Finance really specializes as a provider of models and technology, supporting investors worldwide with their investment decision making. Traditionally, Ortec Finance has been specializing in developing these models and software for backward-looking performance measurement and monitoring, as well as forward-looking risk-return management. And over the last 3 years or so, since we've been building up my climate and ESG team, we really focused on integrating these ESG and specifically insights into the mainstream financial tools. Now, essentially, what it means is that rather than offering kind of standalone green tools, we specialize in making the blue tools climate and ESG aware. And we typically do this by taking a data agnostic approach, because investors often already work with specific data sets and they typically know best which data suits their specific needs. So it essentially means that we bring the data, we bring the models to the data and usually can work with various underlying of these data sets. I will explain a bit more about what this means throughout our conversation today, but maybe just to give you a bit of an introduction, I would like to bring in also the importance of collaboration when we talk about ESG data and the meaning of open source approaches that are really becoming very meaningful in the space, and also the need for new technologies such as AI and machine learning.
Thank you, Lisa. And after this introduction, we can start looking into some concrete questions. And we're going to start with the problems so that we can move on to some more positive questions afterwards. And we're going to look at a specific market segment, so the high yield companies where the data might be missing or is harder to find. So Mari, I'd like to ask you for your perspective on that as you're working with these companies.
Sure. So as a credit portfolio manager, my perspective is very, let's say, trivial, operational. The first hurdle that you have in the credit space is how do you map the existing credit universe to the ESG data that has been, so far created for a more equity universe. Once you've overcome that hurdle, and usually that comes with mapping to the closest parent company that is listed, you realize when you invest in a wider universe like the high yield one, that you've got smaller companies, and actually 50% of your universe is made of companies which are not listed. Who says not listed says no requirement for extra financial reporting, even for reporting financial information, actually. And you find yourself in a no man's land of ESG data. It also hasn't really been at the focus of third-party data provider because they were not the most concentrated positions that clients might be after. But this is really the area of the market where we are focusing on. And you can explain this by the lack of disclosure, as I mentioned, because mostly non-listed. The lack of coverage that you have from third party, where maybe later the solution will be AI and other solutions. And the way we tackle this is mainly around encouraging issuers, like companies we meet, to give us information. So we practically use the primary issuance that period to meet with management and to get access to the information we need to do our climate change assessment or wider ESG assessment. And we usually encourage collaboration on this because as much as data standardization is a huge issue in the space, I think those gaps in the universe impedes us from going further and applying a real, ambitious ESG approach in products which are tied to private or smaller companies.
Thank you, Mari. And interesting to hear about how you're reaching out to people around, to crowdsource in a way your data collection process. Mervyn, you're working with this company as well. Do you have a perspective on this question?
Yes, I think one thing Marie said is important in the sense that when you're dealing with high yield companies, be it a private company or perhaps an emerging market company, you often deal with transparency issues not just with ESG data, but with all financial data. We as the credit rating agencies have the ability to go to an issuer and talk to them. In time, you're not always going to get as much clarity as a public listed company. And so there's a lot of questions in terms of how do you deal with that? And the first question is, do I have enough data to make any assessment on this company? Because I think for us as a credit rating agency, let's say on the financial data side, if there's not enough data to even apply our criteria, then we won't even rate it. But let's say you have a bit of data, enough to rate an entity, but not all of it. What do you do? And I think there's a lot of different ways investors have taken this approach and analysts have taken the approach, which is you consider the fact that there's an uncertainty or opacity premium in some way, acknowledging that there is a lack of data. And then depending on how you approach ESG, you would have to then consider, okay, for this company and the ESG issues and risks that I'm looking at, what can I tell from their business model and what and their general operations, region or country? What can I potentially tell about their governance, environmental and social issues? If it's mainly a renewable company that you are, but you don't know the full details of emissions, you still would expect there to be a bit less risk than, say, fossil fuels and oil and gas. And so I think there is this management of, even though there's not complete data, just having enough data to be able to make some assessment of the ESG risks.
Thanks, Mervyn. And to the panelists, if you're burning to react on a question, please raise your hand so that I can also give you the floor. And so this is dealing with the lack of data on the one hand. Another challenge is dealing with the amount of data that you have for a given company or a given point. For example, you have an ESG score for a company, you compare it across providers, and you don't have the same story. So, Laurent, I would be interested in your views on this question.
Yeah, I mean, definitely there was an excellent analysis made by the MIT, which showed that there is a huge variance, or I mean, there are huge discrepancies between ESG rating for the same company, which is not the case in the financial data. The correlation rate is close to 1. But in the ESG space, the correlation I think is 0.54 or 55, which is very, very low. So that's a problem. So I think there are at least 2 things that are being done now to mitigate this. The first one is the EU taxonomy, which will come into place in a couple of months from now, where there would be a kind of common language to evaluate the green part of the business of a company versus the less green or versus the brown part of the business of the company, following a set of criteria. It's quite complex, by sector, so it's very technical. And I think it would be difficult to put everybody at the same page, but still there is this willingness to do so, and we need to acknowledge that it's a good thing, and I hope that it will be implemented sooner than later. The second thing is the recently named, that it was last Friday, the EU named a new task force to work on non-financial reporting standard. The EU is willing to come up with a reporting standard for non-financial data. The same way we have a reporting standard for financial data with IASB or IFRS. We don't have this in the non-financial space, and it would be very helpful to have something which would be adopted by all the country, hopefully. I hope that this would be the case. At least there is a try, and I'm very much looking for the result of this new task force, because it will facilitate the work of everybody if everybody's speaking the same language. So that's what I can say on this first elements. Then we will go probably deeper in the discussion.
Thank you, Laurent. And Jacob, you touched upon this topic in your introduction as well. So would you like to say a few more words now?
Yes, absolutely. And maybe I first just add a comment to what Laurent said, because I actually slightly disagree with him, politely so, of course. And maybe even make it even a further issue. I think Laurent mentioned a correlation of around 0.5. We've seen cases where that is even lower. And something that really hasn't been discussed so far is not just that you use ESG data, but how do you use the ESG data, and with what frame of reference? Sometimes we refer to the data or the services as ESG ratings. And I actually think that's a bit misleading, because it gets us too close to the traditional space of credit ratings that I'm sure Mervyn can elaborate on as well. So I want to caveat by saying that clearly, on one hand, we want to have more harmonization, we want to have more standardization, but I don't think we should strive for perfection, or at least we shouldn't strive for 100% harmonization around it. There is still value in differences of opinion, and in many cases, methodologies dictate outcome. And it's not always that you can rightly say that one methodology is more correct or less correct than another methodology. So as a starting assumption, we need to be mindful about that it's not just about increasing correlation. That being said, I clearly would support and am in favor for overall market harmonization in the broader field of ESG data, how ESG data is recorded, how it is being used, and what we can assume from it. As a practical point as well, simply just making it easier, making it more efficient to communicate the data. Various different initiatives such as SASB, GRI, and others have made attempts at doing so. We've actually earlier this year have seen an alignment of SASB and GRI trying to come up with a unifying approach to doing that. So again, as mentioned, you're going to have increasing focus on regulation, and that's positive. But I would very much encourage also that we actually are a bit patient and see how the market develops with time, because it will also need to be based in how the market can actually use that data and wants to use that data.
The objective of, I think, the taxonomy and this new task force, I mean, the standard that the EU will come up with is to try to create a common language. Then you can have a methodology, and you can, if you are very good, you will have the best methodology. Then you will outperform on your product. You will have the best risk return, and then it will be on you with your internal knowledge. That's number one. Number two, I wanted to say that, I mean, it's not to preach my own chapel, but at CDP we standardize the data, I mean, to make it comparable. So it means that people who respond to our questionnaire, they can use SASB, they can use GRI, they can use CDSB, they can use TCFD, and the output is something that we would like to be comparable by sector, by regions, and this is a kind of harmonization to help investor compare the data. This is what we are trying to do.
Thanks both. And we're having a question, or we got a question from the audience on specifically data availability, and also there's a question of standardization for data around companies in emerging markets. Does one of the panelists want to take that one?
I mean, I can start. If we have this, oh, sorry. I mean, I'm just 2 minutes. If we have this EU standards, then I hope that the people in the emerging markets will adopt this, and it might facilitate the job.
I was actually going to go back to a little bit about what Jacob was saying, in the sense that, okay, he mentioned credit ratings was different in terms of there's quite a bit more correlation than ESG data. And one reason for that is it's quite clear what you're measuring with credit ratings. You can assess it 10 years after the fact and say, have credit ratings come down over the period, and has there been a higher rate of default? With ESG, the definition of what is sustainable is a lot less clear. Of course, there's the EU coming in with a taxonomy to be clearer about how the EU sees the process. When we start getting to emerging markets, you hear a lot of differences in opinion, not necessarily good or bad comparatively, just different. And so I'm based in Hong Kong, and in Asia, there's a lot more conversations about the role of transition because there is a lot higher dependence on fossil fuels compared to renewables in a lot of Asian economies. And so the conversation in terms of what is sustainable is about how do we get to a low carbon economy in a more cost-effective manner. That might be a different conversation in the EU, that might be a different conversation in Latin America. And I think in that context, it becomes important to understand when it comes to emerging markets, just the perspective that they're coming from. Governance is another issue where a lot of governance structures can be quite different to, say, what is seen more commonly in Anglo-Saxon economies or European economies.
Thank you, Mervyn. And although we could continue on this topic for a little while, I suggest we move on to the second part of our panel to look at some of the improvement that are made to the data, some of the technological development to expand the data. And before that, we're going to start by looking at how the data is used at the moment. So, Lisa, I'd like to hear your views on the effects of ESG data on portfolio risks and return.
Yes, thank you. So in my response, I would focus particularly actually on climate risk data rather than ESG data more broadly. And actually, it's one of the questions that we were very busy with as a team when we first started to think how to integrate ESG into traditional existing risk return tooling. And we find it very important that you can quantify these insights, because that's essentially what will really help investors in their daily decision making. So what we tried to do for our climate scenario analysis is we thought, how can we provide additional insights? So how can we make it climate risk informed, so to say, across asset classes, and see how these climate risk aware versions can then be used. So to give you a bit of a flavor, once you develop a methodology to really integrate climate risk data and information into these traditional kind of economic scenarios, what you can really see is it does make a material difference to what you currently assume as estimates. So, for example, if you imagine, say, comparing your current GDP growth assumptions for, let's say, Europe, what you would see as a result is they would be 2 to 3% lower than your current expectations by the year 2050, if we do manage as a world to transition to a below 2 degree scenario. But alternatively, if we fail to transition, this delta to a climate uninformed baseline outlook, so to say, increases to already more than 8% difference by 2050. And now, many scenarios and so on look at this macro change in macroeconomic outlook. But of course, you have to translate that to what it means to your financial risk implications, risk return implications. And our insights really, we work mainly with pension funds and insurance companies. You can really see that, just to give you an example, the European listed equities, the impact compared to what you're currently used to have in return expectations could be 5 to 15% lower in that same time horizon for if we manage to transition to below 2 degrees world. But actually, alternatively, failing to do so could imply that European listed equities are impacted by more than 30% compared to baseline expectations. So once you spin that further, and for pension funds, for example, we really see that some of them have an extreme risk exposure to these kind of climate scenarios, and it means that their funding ratios, are under threat, for example. So basically, my conclusion is what we see is it is extremely important to integrate also quantified ESG data and see the implications of risk and return.
Thank you, Lisa. And we have a related question from the audience. So, Jacob, I will ask you to add your thoughts on this topic and specifically as well on. So, Lisa was speaking about the E, and on which of the ESG factors you focus on, or which are the most relevant when assessing credit risk. And we got this question from Philippe Marne from the French Ministry of Ecology. So which of the ESG factors are most relevant when assessing credit risk?
I suppose you mentioned that was directed for me, but I think Mervyn can chip in with some clever thoughts as well. I think it's really an important question to recognize that ESG is a very simple way of communicating something very complex. Essentially, when we're looking at a sustainability analysis, inherent in that is complexity. We've seen with the European taxonomy the notion of do no significant harm come up and since been used quite a lot and referenced. And just that simple notion of do no significant harm, really trying to understand that regardless of whatever project or whatever investment or whatever component you're looking at, you will look at it from one perspective, but the sustainability context implies that it is not just the initial apparent aspect of it that you need to take into consideration. It is the broader subsequent value chain, if you will, of either investments or production facilities or whatever else it is that you're analyzing. And so you might start with an E discussion and you will end up in an S discussion or a G or whatever it is. We generally refer to the concept of materiality, of something being material in a given context, and that is generally what you want to focus on. Materiality, again, is a subjective view. Some will have the view that a given ESG factor is material to a given company, whereas others will say that it's not. And if we're looking specifically at ESG and how that relates to, for instance, credit ratings, then you also need to have an understanding of materiality can be sustainability-wise, so it could be the actual impact on the nature, or it could be financial materiality. So you can have one company that has two very different conclusions on the materiality assessment based on whether it's something that is financially material or whether it's something that is sustainability-related wise material. I usually give the example of if you have a company owning a large set of forest assets. Biodiversity is generally regarded as a very relevant and material aspect to forest managing companies. And that is clearly relevant and true on the sustainability side of the equation. But if you look at the side of the equation, at least if you look from a short-term perspective, if a given forest operating company will issue a bond of 3, 4, 5 years, maybe the biodiversity doesn't really have a financial impact on that given company on a 5-year horizon, because the negative impact of lower biodiversity won't really affect the existing stock of wood until 15 or 20 years down the line. So it's a tremendous question, but it's a question that you can't really give a simple answer to.
Thanks, Jacob. Yeah,
maybe I would just jump in a little bit. So that is our bread and butter, actually, in terms of we created these ESG relevance scores at Fitch to specifically answer how relevant and material are ESG issues to our credit rating decisions. And if you look at the data, you'll find, let's say for the global corporates portfolio, just over 20% have been influenced by ESG in some way. And a large percentage of that, or the majority of that, is due to governance issues. And really, that's not really too much of a shock. Governance has been part of credit rating criteria way before ESG became a properly used acronym. Now, I think there's one thing to look at in terms of thinking about governance. It's very different to, say, you might think about climate data, because with governance, you may think that poor governance could potentially lead to poor allocation of capital, or it could potentially indicate the higher risk of, say, governance scandals or issues bubbling up. And so if I back tested the data, I may be able to say, governance information is able to give me some insight on how potential downside scenarios and help me mitigate downside risk. When Lisa talked about climate data, I think there's a little few nuance difference in the sense that back testing climate data doesn't make as much sense, because the reason why a lot of people are incorporating climate into their portfolio is the fact that climate regulation is tightening, the severity and frequency of physical weather events are increasing, banks and asset managers are changing their financing decision. And so we're talking about decreasing exposure for a risk that's becoming increasingly relevant in the future. And you do see that in relevance scores in the sense that environmental risks are becoming increasingly relevant.
Thanks, Mervyn. And we're gonna stay on the topic of climate, and we're gonna zoom in on the measurement of portfolio's temperature for a while. This is a topic that we see more and more, and there are also a wide range of tools. So, Laurent, could you maybe tell us about the different approaches, how you see them, and how they're likely to evolve in the future?
Yes, absolutely, and more specifically because we just launched 1 month ago at CDP the CTP temperature rating. We believe that the temperature pathway will be a reporting tool for investors, for the funds. It will be a reporting tool for index provider to calculate the temperature of the CAC 40, for example, of the S&P 500. And we believe that this might be put into regulation also. We hear here and there that there might be some revision of Article 173 in France, which will require investor to calculate the temperature of the fund. So we're very happy at CDP to have launched this temperature rating based on the methodology that we co-developed with WWF. And it's a tool that it's very simple. We as we receive all this corporate data, the environmental corporate data, one of the question is the emission reduction target of the company for scope 1, scope 2, and scope 3. I won't go that much into the detail. So we take this as the input of the model. We take what the company has as emission reduction target, and it's diverse. It can be in absolute term, it can be in relative term, it can be not per euro produced per megawatt hour. It can be, it's very heteroclite. And we transform all this different information into one single figure, which is a temperature pathway of Suez, of Veolia, of Apple, and then we aggregate that at the fund level or an index level. So the thing here is that there is a very so you can check this methodology, and there is also an excellent analysis that was made by a French think tank called Institut Louis Bachelier, which is, I think, the first of its kind on the market, analyzing 12 temperature providers, and it is called the Alignment Cookbook. So you can search on Google. It's a very technical analysis, but the more we go, the more investor will need to calculate the temperature. And then the next step will be to put a target to the temperature of my fund. And this is what the science-based target for financial institution is developing. That once you calculate the target, the temperature of your fund, if imagine it's 2.5 degree by 2050, then you need to put a target to be 1.5 degree compliant. So you can say in 1 year I will be at 2.3, in 2 years at 2.1, and in 6 years at 1.8, for example. So you need to have a trajectory to decrease this temperature. And in one single figure, you can incorporate a lot of the information that is on the market in terms of environmental data. This is why I think this tool will be widely used by the market.
Thanks, Laurent. Yeah, go ahead.
I think I'm next, and I just really want to jump back on it. Obviously, we are using CDP data, and basically 2 years ago, when we started our carbon impact credit strategies, we had the hurdles I mentioned, and we really wanted to have a portfolio which is aligned with 2 degrees. But what does that mean when you can't measure the temperature of your portfolio. And the fact that now CDP has had this methodology and that we have industry, the industry talking about it, about the different approaches, whether you have a top-down or bottom-up approach, whether you're talking, looking only at carbon-intensive sectors or every sector. I mean, at least now we're starting the discussion and we're aware of the different biases of the different methodologies. Because 2 years ago, we did the exercise with one of our equity fund. We ran it through the different temperature solutions out there, and we had results ranging from 1.5 to 3 degrees. So it's really hard to, make your mind as to which one is most relevant. So the way, as a bottom-up, active asset managers, you have the tendency to go bottom-up. You look at the assets, you look at the company specifically, in which context it's operating. And this is the way we've taken for this, the 2 degrees measurement so far. So you need to look at a company in the context where it operates, where the regulation it has to face. So you can't compare a Chinese power producer to the French one, right? There's just no way that you can align them under this, next to the same reference scenario. What we use as a baseline is the IEA reference scenario. So there are limits to that in a way that you only get scenario for high carbon sectors, the lower emitting sectors like the banking ones. You don't have any reference, but there are evolving works on this. But I would say that I would really encourage to use the company strategy, what they say they will do, but confront that to what they've done in the past. Do they have a history of committee of doing what they say they would do, and then confront what they're currently doing, the investments, the governance, and the whole organization of the company. Are they getting prepared to climate risk mitigations, and how does that project in the long term until 2030 or 50 or whatever, against what the IEA recommends. This is the approach we've taken so far. It allows us to measure temperatures in our portfolio on carbon-intensive sectors. The CDP methodology has just been out, so I can't wait to start it and get my view on it.
Laurent, a few more. Yeah.
Something we will face the same problem the problem we started with. The lots of different ESG data. The problem with the temperature will be the same. I mean, if you have a fund A using a methodology to calculate the temperature, then this fund A will be at 2.5 degree, and then you calculate for the fund B, another asset manager is using another methodology to calculate the temperature, and it's going to be 2.3. Can I compare the 2.3 calculated with another methodology to the 2.5 calculated with the first methodology? That's a problem. So this is why we really believe, we would like at CDP, given we launched this 1 month ago and we have a lot of question now, a lot of interest, and I hope we're going to be, not the standard, but as much as possible to disseminate these temperatures so that we can speak the same language and compare apple with apples.
Thanks, Laurent. And for those in the audience interested in this topic, I would also invite them to look at the PACTA tools from the 2 Degrees Investing Initiative. It's not a temperature score assessment per se. It's the assessment of the alignment of portfolios with a 2 degree scenario, but it's also comparing to IEA scenario that Marie mentioned, and it's also bottom up, looking at the assets in different sectors and the capex plan, so how it's going to evolve over the next 5 years. And so we've heard again and again that data quality availability standard can be a challenge. So now we can look at ways to address that, and I'd like to hear Lisa's views on the role of AI and machine learning that she mentioned in her introduction.
Yes, thank you. Maybe just just briefly on the role of open source, which is something that at Ortec Finance we really embrace and support, because just to wrap up kind of the conversation we just had, and to underline also what Laurent mentioned about the SBTI tool that is about to be launched. There are also a lot of kind of the new thinking is being applied, because it's really developing code base, which will be launched during New York Climate Week. And that code base is really open source and data agnostic. So again, it's actually bringing the tool to the data, and it will allow and enable users, to integrate it into their own in-house systems, or data providers to integrate it into their offerings. And B, it really also allows you to run various of the underlying data sources to also compare and contrast those temperature scores. And I think for me, the most fascinating thing about open source thinking and open source licensing is also that then the community should take this initial code base and can build on that and can improve it by working together and having this very transparent methodology of getting from the input to the end temperature score. So personally, I'm very excited to have been involved in that process as well. But yeah, maybe just briefly on the importance then also of AI and machine learning. We see more and more investors wanting to complement, say, the more traditional ESG data that we have been covering during this panel with data and information that can be brought in through AI and machine learning. And for that, just to give you a concrete example, is we have in-house also experts on these topics. And what we have been doing is actually develop a way to kind of collect in real time all the ESG related news around the world, which means you're not biased by the languages that you can read yourself, for example, but you really get kind of this neutral way of collecting massive amounts of ESG news data. And then through machine learning, this can be filtered and analyzed. And basically what gets presented to you as a user is only what is very relevant to your specific companies in your own portfolio, and what is most relevant, say, based on the SASB materiality matrix to your specific ESG data interests.
Thank you, Lisa. And thanks for raising the question of open source as well. It's also it's the backbone of asset resolution to try to provide data and make it available as much as possible, and the methodology as well. And we can see that helps with the transparency, that can help with standardization as well. If we're allowed to, sometimes we're not, of course, there are licensing restriction, but if we're allowed to go beyond what we provide as a score or as an indicator, it really helps people understand where it's coming from and compare. And we see that there are more and more people pushing for that. So there is an open source and collaboration way, which is I find very exciting to see. And I think Laurent, was that a hand raised?
I mean, I have a problem with open source. I mean, it's beautiful. I love it. Everybody has the same data. Everybody can work on the same ground. Like this, it's spectacular. I mean, in terms of economics, the financial data today cost a lot of money to be prepared and to be analyzed. And the non-financial data doesn't cost a lot. And in economic theory, when you have a niche product, it should be much more expensive than a commodity. The financial data today is a commodity. The non-financial data is a niche product. And what the people are willing to do now, and the market is trying to go there, and I'm not sure it's going to be sustainable, it's to have open source, free data no cost, that everybody would be able to use when this non-financial data must be considered as a niche product. I'm not sure this is, over the long run, this would be sustainable. I'm very much curious to see how this is going to be happening on the market, because I see a major distortion there.
Thanks, Laurent. And yeah, I think we're still very far away, and I'd love to continue this discussion. I can see we have 5 more minutes on the panel, and we have some questions from the audience as well, including regarding COVID. So Mervyn, I believe you've made some assessment on the impact of COVID on the importance of ESG. So if you want to tell us a little bit about that.
Yes, and I think the way that we look at it is the fact that COVID has had has led to fundamental structural changes to economies. The impact has been profound. And we probably haven't even really seen the full effects yet because the pandemic is still occurring. But we can tell certain things happening. So because of the economic impact that COVID had, it does mean that there's large fiscal stimulus by a lot of different countries. Tied to that fiscal stimulus, depending on the country or region we talk about, are tied to green objectives. So the EU is probably the most prominent example, but you see it in other areas like South Korea. So there's quite often we've seen, well, not quite often, in certain regions, we're seeing stimulus packages being tied and used for green objectives. In certain regions, we're not. And so I think there's this potential trend where you have the transition accelerating in some areas and slowing down in others. There's also, I think that in terms of that big macro impact is the fact that balance sheets of governments and companies have been very badly hit. And so if you look at current energy investment bans, it's been hit across the board, but oil and gas investment has come down quite a bit more than renewables. So you do see some shifting of priorities. Now, the question is, when we go past the recovery and the conversations about debt sustainability becomes more prominent, how will governments and how will companies deal with that? Where will they cut or where will they manage spending and investment? Will they be prioritizing ESG issues, or will they be not managing it so well because they are trying to balance the books? I think a lot of the longer term repercussions for ESG are still to be seen, but it does make it more important to look at it because the world has experienced this huge shock.
Thank you, Mervyn. And I think Maria might have a few words on that topic. So if you could briefly share your thoughts, and then we'll conclude as we have 2 minutes left.
Sure. Well, my perspective is very close to Mervyn's. I mean, I was about to say that the short-term negative is the impact on balance sheet and the shortfall in cash flows, which will reduce maybe non-financial transformations, which might go, at the bottom of the pile when companies have to face urgent liquidity issues. The positives would be in the transformation that occurred in the oil and gas sector. I'll just highlight that 40 companies in the oil and gas and coal sector in the US have defaulted since the beginning of the year. And that oil major have reviewed their long-term price assumption and therefore depreciated their balance sheet. So that is the final acknowledgement that we are going towards a lower carbon world. Obviously, we need this to be more ambitious, but it all goes in the right direction. As for the recovery packages, I would just say that the number I have is around $800 billion at the moment, which are recovery packages linked to green strings, the ones that Mervyn mentioned. Definitely going in the same direction as the EU talking about a carbon border adjustment tax system that would pretty much avoid carbon leakage in Europe and potentially harmonize the global carbon trade. So those are longer term, perspectives that hopefully we will know more about once we can just get out of the water with regards to the sanitary crisis.
Thanks, Marianne. I think the message is loud and clear, and I think we're all in this panel convinced by it. ESG data is there to stay, and ESG considerations are there to stay for a little while. And I guess it's time to close. I'm afraid, Laurent, it's time. So I think we now need to close the session. Thanks a lot for everyone. And I think one thread that has been through the panel is that there is obviously lots going on in a lot of different directions, and that collaboration is key to avoid that things are developed in silo, and that the diversity of the data that we have in the title of our panel today is an advantage rather than an impediment to action. So thanks a lot to our panelists. Thanks to Climate Action for organizing the talk, and have a nice afternoon or morning to everyone.
Thank you, everybody.
What a wonderful panel. Thank you, Naomi, for sharing that. And we hope to see you again soon. So we've had a jam-packed day, lots of things that we've covered in part one. Remember, there are 3 more parts and lots to look forward to. But in terms of today, in 2 sessions, I think we've covered these key questions around pension funds and alignment with Paris. We've definitely covered some of the key opportunities as well as challenges for institutional investors to take account of ESG and integrate that into their decision making. And we've also touched on COVID, the challenges and opportunities that generates. I think some of the kind of the key actions, at the very beginning we heard from Magnus Billing from Electa about asset owners and the Net Zero Asset Owners Alliance and the importance of asset owners participating in that collective journey to figure out how to align with Paris. And that seemed to me like a very powerful call to action. Another call to action was from the headline partners and sponsors of this event around how asset owners and asset managers can work together to achieve better outcomes. And that's something that we've got to get right, aligning incentives between asset owners and asset managers. And then the last panel, fascinating panel, I was listening in, covering the breadth of tech development from natural language processing and the ability to interpret huge amounts of existing ESG data and other related data in a way that can help identify signals, through to new forms of data capture and analysis that allow you to get asset level data using satellite imagery and artificial intelligence, and how that can be used to inform better financial institution decision making. So a whole spectrum of innovations there, tied to technical and supervisory changes, regulatory changes, including the taxonomy, and also some allusions to possible announcements that will happen later in September, particularly around UNGA and New York Climate Week. And we'll hopefully be able to talk about some of those later in the month. We're going to continue talking about all of these issues on Friday, and I hope you can join. Do put it in the calendar. And I just wanted to remind you, of course, that the event platform is open throughout the month, so you can use that. You can log in at any stage of the week to participate, to network, to talk to people, to engage with exhibitors, to engage with sponsors. And just remember also to put stuff in the calendar. Otherwise you'll miss it. And just to end by saying thank you, it's been a great pleasure, and I look forward to seeing you on Friday. I hope you have a good rest of the day or evening, wherever you are.